Hi, welcome back to financial accounting. I hope you had a good chapter 1. And now let's talk about chapter 2. First of all, the chapter 1, we talk about the framework of accounting, which is the measuring and measuring the business activity and communicating the measurement to the external parties. And this chapter, what we want to do is to be able to really do the step 1, which is measuring and recording transactions. Okay, so first of all is that we want to understanding what are the basic steps that we need to do to identify, to record the transactions. And there's the 6 steps in recording financial transaction. First is let's think about a company has a business transaction with many different individuals, right? And other companies. Examples are such as selling product to a customer, or purchasing supplies for a vendor, or paying salaries to an employee, or borrowing money from a bank. And these transactions actually are referred to external transaction, meaning that a business as myself and other people as external to the business, because the company itself has a different bank account, has different, let's say they go to bank, they apply different, that's a separate entity, and the employee or the bank or the suppliers, they are all totally different and not an economic entity. Hence, we can separate this economic entity. We needed to, so as a company itself, as a content, we needed to measure these business transactions so they can be communicated to the external investors and creditors and other statement users. Hence that in this chapter, we want to focus on the measurement of external transactions occurring during a period of the one period. And then in chapter 3, we will discuss further about how to record those internal transactions measured usually at the end of the period. And this includes events that affect the financial position of a company, but does not include in exchanging with the external companies, okay, or individuals. Okay, so in chapter 2, let's figure out how do we recording transaction related to external transactions. The first thing we need to do is to find the gathering information about that transaction. We call it use source document to identify what is affected. This should be account, okay? We wanted to find the source document, identify the accounts are affected. And once we get the document, we can usually identify the date and then the nature of each transaction, and the monetary terms such as how much the money and in what kind of euro or Canadian or dollars. For example, a sales invoice might if you have a sales invoice or you have receipts that you, such as you help the company buy some stationery, you go to Walmart, you have the original document, you can see, okay, I purchased this on, say, August 13th, and I bought this many items, and each of them cost how much. And this dollar amounts of this payment will be recorded counted as part of the expenses of the company or school which buying the supplies, right? And step 2 is that once we get hold of those source documents, we want to analyze the impact of the transaction on the accounting equation. What does that mean? This means that once we understanding the essence of the transaction, we can understand what impact of that specific account. And then we talk about accounting equation is asset equals liability plus equity. Once we understanding the essence of this transaction, we can figure out is this transaction is impacting on asset side or liability side or equity side, right? And if it's impacting on asset side, is it increasing the asset or it's decreasing the assets? if it's increasing the asset, am I gonna debit the asset or am I gonna credit asset? If at the same time the same transaction is gonna have a dual effects on the liability side, is this transaction increase the liability or reduce the liability? Hence, the step 3 is that once we identify the impact of the transaction accounting equation, we can assess whether this transaction results in a debit side or credit side to each of account that has been impacted. And step 4 is to record this transaction in a form of journals. Journal is a way we talk about in accounting. It's a way to record a transaction. How did it happen? And then it's convenient for accountant later on to put them into a more organized form. Hence, when we journal, like when we take journals and we call it, okay, August 13th, today we did this and that, this and that, this and that. Same thing. Journal here in terms of journal entry of accounting is also recorded. Has to have a date, has to have what happened to that date, right? Or what happened here is gonna be the accounts, right? And then we're gonna debit account or credit account, and then with a month. So this journal we are using here is to record the transaction. And step 5 is that we want to post those transactions. Say that we record a journal for the whole month. And then after this month, we wanted to post all these journals into a general ledger. The ledger is contained a lot of accounts together. We want to summarize the impact of every day's transaction towards each account. Okay, and then we come up with a trial balances. Okay. Okay. So let's see. In next slides, we want to talk about what meant accounts. Accounts means an item that can record or contains all the transactions related to the entity over a period of time. For example, you have a cash account, you have a supplier's accounts, you have equipment accounts, right? When you borrow money, you will have accounts payable accounts, you have a salary payable accounts, you have utility payable accounts, you have a tax payable accounts. Let's give more example. What is a cash account specifically mean? It means all the transactions affecting cash, okay, are recorded in this cash account. When the company pays cash, it will decrease the cash. If the company receives cash, it will increase the cash. So the balance of these accounts equals all the increases minus the decreases. And this way, all the accounts can record the different transactions. For example, if you buy suppliers, that means the suppliers in your company is increasing. If you use supplies, that means the supplies are gonna decreasing. If you purchase equipment, that means this equipment is gonna increasing. But if you use or sell the equipment, that means the equipment are decreasing, right? And accounts payable means that when you owe someone some money that you need to pay within 1 year, that short time, like say you buy supplies from a vendor but you haven't paid yet. So this accounts payable is recording short-term liability that you owe short-term debt. Then when this kind of event happens, you will record the account payable increases. Once you pay off the vendor or suppliers, then this accounts payable balance is going to decrease. Stockholder equity account we kind of talk about a little bit in chapter 1, and it's composed by 2 components, right? Remember, common stock is always due to we are issuing stocks. And return earning means that every period of time the company make income, and a portion of it is going to return within the company, and portion of it is going to distribute as dividend. And these 2 components add up together is equity account. Okay, And then because we have account to record all the transactions related to a particular item over a period of time, there's so many accounts. Hence, we want to give you a name list of the accounts, and then in a very professional words called a chart of accounts. Chart of accounts is a list of all account names used to record transactions. Okay. And then next thing we wanted to do is to analyzing the impact of external transaction on accounting equation. That's our step 2, right? So once we gathered the receipts and stuff, and we understand, oh, I buy or I sell or I receive money, I owe someone money. So all these things that we figure out what is going on. The next thing we wanted to do is that how does this transaction impacting the accounting equation? Okay. So the effects of the transactions on basic accounting equation, we have mentioned we call the golden accounting equation, which is the assets on the left hand side equals the liability plus the stockholder equity on the right hand side. So that means that the resources of the company either equals to the claim to the resources, right? So these two things are always forever equal, right? The resource you have in this company has to always equals the person who have the claims of those resources. And we call this that, and then that the great interesting thing about accounting is that each transaction that you decided to record will have a dual effect on basic accounting equation. So one transaction you need to find the dual effect, meaning that one transaction will impact at least two accounts. Okay. So for example, let's say borrow money again. When a company borrows cash from a bank, its financial position is affected because the asset of a cash is increases, and at the same time the liability is increases as well. Hence, the company record that event in its accounting records. On the other hand, okay, if you find that there is a transaction that am I supposed to record this? Is this a legitimate accounting record? Let's listen this example. So one day that you hired say Michael as a employee, right? That day you hired him and then you signed a contract. And is it a economic transaction need to be recorded by accountants? No. Okay, the answer is no, because that action, the hiring action, does not change the company's assets. Because the hiring Michael does not means the asset of the company increase or decreasing, or the liability increase or decreasing, or stockholder equities increase or decreasing. It's merely a HR transaction. It's merely a contract, right? And when is that gonna affect? When the Michael is hired and then you need to pay Michael's salary, that's when you need to record a transaction. And that specific equation is that you have to record the employee salary expense and credit cash, right? You were decreasing the cash because you give Michael the salary in cash form, and then also you increase the expense. And you will be wondering, oh, where's expense in this equation? Hold the horse. We will talk about the expanded equation in less than 10 minutes. Okay, so right now let's just say that all this transaction impact two accounts. So I want you to always ask yourself, which account is it? What's the first account affected? What's the second account affected? How does it affect the first account? How does it affect the second account? And also, if the total asset increase, okay, then the liability and the stockholder equity increase. Because when asset side increase, either one of them gonna increase to balance it off, right? So if left hand side grows $3, the right hand side, it could be the liability increase $3. It could be stockholder equity increase $3, right? And if the asset decrease, say $6, right, the liability side could decrease $6, and the stockholder equity side could, or the stockholder equity side decrease $6. It's never happened that asset side decrease 6 and the liability side decrease 12, because it's not balanced. This has to equal, okay? Whatever you do, each transaction you record it, you have to double check is the left hand side equals the right hand side, because it's always equal. And at the same time, you need to remember each transaction have a dual effects on the accounting equation. There must be two places being hit by one transaction. We're going to give you a very specific example. And understanding the effect of a transaction is that I kind of mentioned a little bit. For each transaction, you need to ask yourself these questions. First, what is the one account affected by this transaction? And then, does this account increase or decrease? Second is, what is the second account affected by this transaction? Does the second account is increase or decreasing? And third one is, does asset equals liability plus equity, right? So this thing must equal every time. Once you record this transaction, asset has to equals liability plus equity. Okay. So let's look I know it's kind of conceptual, and you'll be like, what? And and let's look at example. The example is that so there is 10 transactions happened during the December, involves the external parties of the Eagle Soccer Academy, which is the example we used earlier in chapter 1. Okay, so let's see. Transaction 1, issue common stock, right? So issue common stock is Eagle Golf Academy wanted to be a public company, right? They start selling stocks to the community. The community buy the stocks in exchanging for the stock certificate. The community give Eagle Golf company cash, right? So the investors give the soccer academy cash, and the soccer academy give investor stocks certificate. Okay. So during this transaction, there's assets involved, there's equity involved. Hence, it's a accounting transaction that we can record. So what is the one account that affected by a transaction? First, cash account, right? Second, common stock account, right? Okay. Cash account. So then let me ask you, as if I am a soccer academy, this transaction is increasing my cash or decreasing my cash? Increase, right? Increase by 25,000 because people give me money. Okay. What is the second account impacted by this transaction? It's a stock equity account, right? Because we have a stockholders, because we issue the stock certificate to someone else, our common stock account is not 0 anymore. It's increased by 25,000, right? We start have a stockholders. Okay. So I put this into an equation that we can see whether it's always equal to each other, right? Third step is check whether this transaction make the accounting equation balance. Sell shares of common stocks of 25,000 to obtain the funds necessary to start a business. This transaction actually fulfill accounting transactions, and we wanted to record a 25,000 positive increase in the cash account, and we increased 25,000 increase in a common stockholder account, accounts. And does the asset equals liability plus stockholder equity? Yes, right? Asset increased by 25,000 and the stockholder increased by 25,000. So this is a transaction that increased both accounts. Increased left hand side, which is, cash account, and the right hand side is common stock. So both are 25,000. Okay. So common mistake. Okay. decrease or increase cash, it would be like sometimes like, am I decreasing my cash asset or increasing my cash asset? So sometimes it's tempting to decrease cash as a way of recording investors' initial investment. However, remember that we account for the transaction from the company's perspective, and that the company receives cash from the stakeholder, hence that's an increase, right? We're always standing at the perspective we are a company, okay? Okay, transaction 2, borrow cash from a bank. So this is bank, and this is a soccer academy. Soccer Academy borrowed $10,000 from bank, right? Bank give a cash to Soccer Academy. So tell me, what is the account impacted? What is the two account impacted in this transaction? Okay, great. The first account is a cash account for 10,000. The second account is a note payable account for 10,000, and both of them are increasing, right? Because I get cash from a bank, my cash increased. I owe someone money, I owe the bank money now, so I have a liability of $10,000 increased. Hence, as you can see, after the transaction, my cash account increased. Another $10,000 becomes $35,000 ending balance, right? So the $25,000 I got from common equity issue stocks, and $10,000 coming from borrow money. And now I have a liability for $10,000. I have a common stock for $25,000. Okay. Okay. Transaction 3. I purchased equipment necessary for giving soccer training for $24,000 cash. Once I gathered initial investment from creditors and investors, what I will do is to start to purchase equipment or assets that can fulfill my can benefit me in future, right? Buying equipment or from supplier for cash or investment in equipment is actually a very primary operating transactions, right? So in this process, we have equipment coming from suppliers such as the gate and the balls. So we have equipment that comes into the door, and then we have cash given to the supplier because we pay cash to suppliers. So that this transaction impacting how many accounts? Always two, right? Which one is the first one? The first one is cash account, right? Because we use cash to pay for the supplier, and the second account is equipment account because there's new equipment come to the door. Hence, the third equation is decrease cash account and increase equipment account. So I just want to ask you this question. This is also dual balanced, right? Because we have two accounts involved, but the two accounts are both cash accounts, because the cash is an asset account and equipment is also asset account. Hence, the asset accounts didn't the balance, any balance don't change. Okay, so in other words, the dual effect does not always has to be one on the left hand side, one on the right hand side. It could be both on the left hand side, but one is increasing, one is decreasing. Hence, it's always balanced. Okay. Okay, I want to check your concept. So, what would be the effect on the total asset if a company purchased a land for $200,000 cash? Okay. A, total asset would go up by $200,000, and B, total asset would go down by $200,000. C, there would be zero effect on total asset. D, none of the above. I just talked about it. That let's look at this example. Is that although my cash decreased and my equipment increased, but both of them are involve asset account. Hence, my asset balance doesn't change, right? Same thing here. So if you buy $200,000 land, you will pay $200,000 cash, and you are increasing asset of which is a land for 200,000. Hence, the total effects of this transaction on the total asset is what? Is 0, right? So it should be 0. Answer should be C. Okay. One asset, which is land, go up, and another asset, cash, go down. So there would be 0 effect. Okay. Key point. After each transaction, the accounting equation must always remain in balance, means left-hand side equals right-hand side. Asset equals liability plus equity. In other words, asset must always equals liability plus stockholder equity. Get into the habit of checking the equally often, okay? Every time you need to ask yourself 3 questions. First, what is the account? What's the first account impacted? Second, what is the second account affected? And in what direction, increase or decreasing? Okay. And third question is, am I still in balance? Okay. The transaction 4 is pay for rent in advance. So what is in advance means? Means that I pay for rent now, but I'm not living there yet. Okay. That means that it becomes one of my assets. Okay, we call it prepaid rent. So pay 1 year of rent in advance for $6,000 and $500 per month. So I say I'm gonna move in. I'm gonna rent this academy warehouse, but I have not put anything in yet. I just wanted to lock down this cheap rate. So that's why I paid 1 year in advance. So in this transaction, what is involved? First of all, I give cash to the landlord, right? Second of all, he give me a lease, give me authority to move in there or to use the warehouse, so rent space, right? So this is transaction. But the interesting part in advance means that I am not using that renting place yet. So we consider this renting prepaid rent as a part of asset. Because do you remember what asset meant? Asset means that something can benefit you in the future period, right? So the prepaid rent means that I'm not using the place right now, but I will use in the future. Hence, this prepaid rents will benefit me in the future. Instead of treating the rents as expense, okay? Because it's prepaid, I will treat this rent right now as an asset. Okay, so that's then how we check it? First, it's the impact in cash account. Then the number 4 number here, we'll talk about the 4th transaction. We'll put a 4 here, and we reduce our bank account for $6,000 to give to landlord. And at the same time, we record a prepaid rent, which is considered an asset account for increase for $6,000 because we have the authority or rights to move in there in future period. And the reason the prepaid rent is asset because it can benefit us in the future. We're not enjoying the space right now, hence it's not considered as a rent expense. And then after we do this, we want to double check that we are in balance. Oh, yes. So let's see, 1,000 minus 6,000 is a cash balance of 5,000. And we have a prepaid rent of 6,000. That gives us 11,000 on the asset side. Plus, remember, we bought equipment of 24,000. 11,000 plus 24,000 is 35,000. Okay, so asset side, total asset, I have $35,000. And then we look at the liability. Remember, transaction, I think 2, that we borrowed money from bank for 10,000, and also we issue a common stock. We gather investors for 25,000. So those 2 add up is 35,000. Hence, asset equals liability plus equity. We are balanced. Okay, Transaction 5, purchase supplies on account for 2,300. What does that mean? We buy supplies, means that suppliers give us suppliers and we give suppliers money. Wait a sec. It says on account. On account means that I cannot pay you now, but I will pay you in the future. So that means I owe you, right? Whenever we find there's IOU situation, we record it as payable. So in this case, there's two accounts involved. One is a supply account, another one is no accounts payable account, right? And then they both increasing because the supplier give us supplies, increasing our supplies, and also we incur new liability called $2,300. Okay, hence our asset side had a $2,300 increase. At the same time, we have a accounts payable for $2,300 increasing. That's why the asset side and the liability plus the equity side is still in balance. And the total increase to $37,300. Okay, and then we already talked about the majority of the transaction that impacts asset, liability, and stock equity account, and we call it the balance sheet account, right? And then now what we want to talk about is called expanding accounting equation, which I just mentioned probably 10 minutes ago. And this we call it a basic accounting equation. And we said in the chapter 1, we talk about the stock equity account is a very interesting account. It's a breakdown into common stocks, right? And then it's another thing called return earning. And if you remember, return earning can be expanded to another 3 components, which is revenue minus expenses minus dividend, because return earning is composed by net income, right? And net income is equals revenue minus expense. And then if you want to call it a return, that means net income, portionally of that net income can be distributed as dividend, right? So that's why return earning equals the revenue minus expenses minus dividend, or net income minus dividend. Yeah, so the basic accounting equation is asset equals liability plus the stock equity. It can also written as asset equals liability plus common stocks plus return earning. And it can be expanded even further. It can be equal, understand as asset equals liability plus revenue minus expenses minus dividend, because look, and plus common stock, because this one can be split into 2 components in the pink color, and the return earning can further split it into 3 components. Hence the expanded accounting equation is asset equals liability plus common stocks plus revenue minus expenses minus dividends. Okay, so now let's look at what this applies in terms of real transaction. Okay, the expanded accounting equation demonstrates that revenue, right, increases the return earning. Expense decrease return earning. Dividend decrease return earning. Return earning is a component of stock equity account. Okay. I want to tell you that sometimes I do this because I want you, when you look at the PPT, you have a chance to record what I just said to you, and then that way the answers are in the second slides. I don't want to confuse you, but that's usually what I do. If you see this line like this, you can usually find the answer in the second slides. Okay, so let's look at the transaction 6, providing services for cash. Okay, let's read. Provide soccer training to customer for cash for $4,300. So what does this transactions mean? I provide soccer training for a customer and they give me cash. Immediately, I know the customer give the company $4,300 cash, and the company needed to train those customers, right? And this transaction or this behavior is making money, right? So what does that mean? Means that we have an increasing of cash for $4,300. At the same time, we also have a stock equity account increase for $4,300 because we're talking about expanded accounting equation because we increased our service revenue for $4,300. Remember, the revenue account increased the stock equity account, right? Yeah, because let's see, this was just the revenue increased return earning account. The expense decreasing return earning account. Dividend decreased return earning account. Okay, because we have a revenue, cash from revenue training exercise, so that's why the 4,300 increased the return earning account. The return earning account is a part of a stock equity. Okay, after we do that, let's check our balance. Now our cash increased to 9,300, and we add 9,300 plus 2,300 plus 6,000 plus 24,000, we'll get 41,600. And then we have an extra increase of the return earning account in stock equity part. We have a $4,300 increase, and then we add all the total liability plus total stock equity, we still get 41,600. That means this transaction is recorded accurately. It's balanced. Okay, so then this 4,300 is impacting the first component of the return earning item, right? It's increasing. Okay, and then transaction 7, provide services on account. Provide soccer training to customer on account for $2,000. What does that mean? Means that we're providing service to the person already, but that person hasn't paid us. So what does that mean? Means that we have accounts receivable account increases because someone owes us, we need to go receive from them. We call the accounts receivable. Okay, and at the same time also trained other people. That means we made money by training someone, providing services for $2,000. Hence the account impact here, two accounts is, one is accounts receivable account, second one is revenue account, because revenue is part of return earning account. Hence the equation should still balance, because right now the services increase is the revenue part, which is increased return earning, which is plus sign under return earning, right? Although we didn't receive cash, but we have account receivable account increase. Okay, transaction 8, receive cash in advance from customer. Receive cash in advance for 12 soccer training session to be given in the future of 600. Okay, this is very fun. Rather providing service before receiving cash. We already received cash, but the customer hasn't been trained yet. So who owes who now? I owe the customer, right? Because they give me money, I haven't even done anything yet. So I owe them my services. So the Eagle received $600 from the customer and then need to providing the training in the future. In this case, Eagle cannot report this revenue, which is 600 as revenue. Okay, it's because although the cash is being received, but the service has been provided. Especially in the chapter 1, we talk about the revenue recognition principle, that revenue is recognized only when the goods and services are provided to the customer. Receiving cash in advance from a customer creates an obligation for us to perform services in the future. Hence, this IOU from Academy owed to the customer will be treated as a liability. And we give it a name called deferred revenue for $600. Hence, two accounts is impact. First, I increased my cash balance because I received $600. Second is I incur a liability of $600. Okay, and then let's check whether I'm still balanced. Okay, I add up all the total asset together, account asset, all the accounts balance together as total asset is 44,200, and I add all liability accounts together plus stock equity holder accounts together. I have 44,200. Hence, I'm balanced. And then there is a very important common mistakes that people always making, is that do not let the account, do not allow the account name to fool you. Okay, even though the term revenue appears in an account title, but it's called deferred revenue, and this is not a revenue account. Means that you haven't made the money yet. You owe the money. You owe the services to other people. It's part of a liability. Deferred indicates that the company yet to providing the services, even though it has collected the cash. The company owes the customer a service, hence it's a liability. Okay, transaction 9 is the pay salaries to employee. So the soccer academy actually paying money, salaries to employee, and the employee offering labor to accomplish the training activities, right? So in this account, how does it work? First of all, we know it's involving cash. The first account is cash, and we know it's decreasing because academy give outside the money, right? And the second account is impacted here is labor work, and this is we call it expense, right? Because paying salary for current period cause an asset to decrease. At the same time, it's an increase in salary accounts, right? Which is gonna reduce the return earning. Because remember, return earning, look at here, return earning equals revenue minus expense. So if you have expense happening here, it's gonna decrease return earning, hence it's minus here, right? Expense reduce net income, and therefore it's reduced amount of return earning. A stockholder's equity account will be decreased here as well, right? Stated another way is that an increase in expense will decrease net income, which decrease return earning, and which decrease the equity. Expenses, as long as you have expenses, it will decrease your return earning, and then it decrease the stockholder equity account. Hence, this 9 transaction, both sides are minus the cash, minus the return earning. Okay. And then we said, okay, pay cash, transaction 10, pay cash dividend of 200 to shareholder. So what does that mean? Means that we give back shareholders some dividend. At the same time, they reduce their claims to company's resources. Okay. In this transaction, we said dividend also reduce return earning, right? Whenever there is dividend happening, the return earning account goes down, which stockholder equity account goes down. At the same time, the cash account goes down because cash flow out from the company. And also we want to check, is it in balance? It is, because all the asset adds up is 41,200, and all the liability and the stockholder equity accounts adds up is 41,200. Okay, and now we wanted to put all these transactions, or summary of all the external transactions, into one worksheet. We put asset on the left hand side, liability plus stockholder equity, and then each account name is right here. Cash, accounts receivable, supply, prepaid rent, and equipment are all asset account. Liability account, we have accounts payable accounts, transaction, deferred revenue transaction, note payable transactions. From stock equity account, we have a common stockholder, the common stocks account, and return earning account, right? And then we find that on December 1st, every account is 0, And then because we had 10 transactions, we're translating those transactions, economic transactions, into a numeric measure, and we record it into this worksheet, right? As you can see, every time each transaction have two accounts, dual effect, one increase, one increase, one increase, one increase, and then one decrease, another one increase, right? So in the end, everything will be balanced for 41,200. Plus, we talk about expanded the equation, service revenue increased stockholder equity because it's increased net income, and the salaries decreased net income, hence decreased return earning, and dividend decreased the return earning, and then all this decrease. At the same time, it has balanced another side of the account, right? Okay, so we will work together in a class for a lot of exercise, and you will gradually get it. But I just wanted to tell you, you need to work with one concept is how do I digesting transaction? I needed to first understanding what the first account is impact. Is it increasing or decreasing? Okay. Second, what is the second account impacted by this transaction? Is it increasing or decreasing? And third is that what is the, after I record this transaction, right? This transaction, is the asset equals liability plus equity, this equation still balanced? Okay, I will see you at the next lecture, part 2 of the chapter 2. We're going to talk about debits and credits.